Thank you, Joel, for the introduction. Good day, my name is Pete Compton. I've come this week from Denver, Colorado. Denver is where Platts has one of its primary North America markets, and a lot of our analytics group is based there. So thank you for allowing me here this week with you and for a bit of your attention here for a few moments. As Joel suggested, I'd like to shift our attention a little bit to the U.S. story, and not just the shale revolution, the shale developments and phenomenon that have really impacted the market in recent years, but specifically the impacts that it has had on the North American natural gas market and the ripple effects therein on the global liquefied natural gas market, impacting that global LNG situation. So a slight bit about myself and my team and how we do what we do. I spend a lot of my time working on custom analytics projects. I'm a part of an oil and gas consulting group that focuses primarily on North America, but also other parts of the globe as well, providing clients with detailed analysis specific to their needs. And as far as the natural gas situation in North America, a lot of our analysis there, I'll get into just a touch of methodology as I show you some of our pieces, but as a matter of collecting a wealth of available data that is made publicly available and modeling the rest of the entire North American continent in terms of that natural gas supply and demand, and then forecasting. So the analytics group there in North America does indeed forecast supply, demand, and pricing in natural gas markets, in addition to natural gas liquids and crude markets. But moving on, just to orient us to some of the topics we'll be talking about first today. Again, kind of a review of the shale situation, the shale phenomenon in the U.S., both on the crude and gas side. And after we've done that, we'll shift our attention more specifically to natural gas markets in the U.S. And then third and finally, we'll get into a discussion about the advent of LNG exports from the U.S. because of that growing shale gas supply and the impacts it will have, and it has started to have, on the global LNG market. And after that, as Joel mentioned, we will field some questions and have a bit of more of an interactive session. So a few key takeaways, a few high points that are important as we discuss what's going on in the North American natural gas market and how it's impacting the globe. First off, shale production has dramatically shifted the oil and gas landscape in the U.S., both on the crude oil and natural gas sides, and we'll talk a little bit about the dynamics there in just a moment. Importantly, U.S. natural gas production, in terms of that shale production, is economical at very low prices. And we've seen a low gas price environment in the U.S. for a significant amount of time, but it's important to note that even at a $3 per MMBTU Henry Hub mark, a lot of production in the U.S. is economical. Producers are able to turn a profit, and this will be important for prices going forward. Now, a lot has been said about the global oversupply of crude at large and the impacts that the U.S. production has had on it. But one thing we are really beginning to see, and should see more and more in the coming months, coming years, is the adding to the global LNG oversupply situation is that U.S. produced shale gas. And then finally, exports of LNG in the U.S. depend on an arbitrage window, but that arbitrage window, because of the narrowing of spreads of global gas prices, that window is closing, making it more difficult for shippers to move LNG off of U.S. shores to ports abroad. And that'll play into the situation over the next couple of years until the global LNG market begins to tighten again. So a bit about shale production in the U.S., and as I mentioned, we'll talk a little bit about gas and oil, and just to get us oriented on what conventional drilling or conventional wells producing crude oil looks like versus what shale production looks like on a barrel and time basis. So if we take an average oil well in the Permian Basin in West Texas, one of the key oil plays in the U.S., and look at its decline curve, we see that the initial production rates are not terribly high on a relative basis, and the decline curve for a vertical well, that is a conventional, traditional well in the Permian, while producing substantial amounts or substantial volumes, really has a pretty slow decline. And in fact, about 40% of the life of the well's production comes in the first 2 years of that. Now keep that in mind as we compare this to the next slide, which is going to be the same thing but for a shale horizontal well in the same location. So again, an example for the same basin, same region, but instead of the traditional conventional vertical well, if we're looking at a shale well and a horizontal well, we see a very, very high initial production rate followed by a very steep decline curve. Now, relative to that 40% of the life of the well's production in vertical wells coming in the first 2 years, we see here about 60% of the life of the well's production coming in those first 2 years, and nearly 5 times as much volume coming from these shale wells. A few important notes to make about this. First off, because of that steep decline curve, it's very important for continued production volumes to stay high, that producers continue to drill more wells. Because that decline curve falls off so steeply, so rapidly, if the number of wells being drilled declines substantially, then the oil production will come off. Another way of looking at it would be comparing offshore production, which we see a lot in the Gulf of Mexico, to some of these newer horizontal shale plays. So if we look at the ramp-up phase, we're talking about a 2-year ramp-up phase for these large-scale offshore traditional projects, followed by a very slow, long decline. And on the other hand, we have a very rapid increase in production for a pad site where several horizontal wells are drilled in the same vicinity, followed by a steep decline there. And a couple of notes about how to think about these two in comparison. For offshore drilling projects, we see a huge amount of capital required for the upfront capital investment to start up these projects. On the other hand, it's just a pretty quick, less capital intensive process to drill a shale well, a horizontal shale well. And this is something that we can see in terms of what's going on the last several weeks, in fact. We've seen the WTI and Brent price recover a bit over the last month or two, and there's already been a producer response in terms of the number of rigs that are active in the United States. We've seen 3, if not 4 consecutive weeks of producers as a whole adding rigs to the fleet. A very small number because prices are not yet up there to make a lot of places economical. But we have already seen a very quick response to prices, and this is going to be important going forward. Joel also referred to earlier this morning the notion that crude and gas production in the U.S. has fallen off a bit in response to low prices, but not terribly substantially. We haven't seen production in the U.S. really decline very rapidly. And a significant portion of the explanation for this refers to, or is in regard to technology. If we think about the whole shale phenomenon, it's only about 10 years old. The first shale wells were drilled in North Texas, and about 2005 is when that really came to be on a large scale. So we're talking about something that's only gone on for about 10, 11, 12 years. And what we've seen in the last several years is producers and geologists really understanding this and really getting a feel for how to exploit the shale reserves, the best spots to drill in. And one way we can look at this and actually begin to see this manifest is to compare the number of wells drilled over time to the number of rigs that are out there drilling them. So what we're looking at with this chart is monthly number of total horizontal wells drilled in the U.S. We see we peaked out at the end of 2014 there at about 1,800 wells a month. So that's total horizontal oil and gas wells. Overlaying atop it, we have the number of horizontal rigs that were active at that same time frame. And of course, they do track with one another. But as Joel mentioned, the number of rigs out there in the fleet has been becoming less and less important. And this is why. If we look at a simple ratio of the number of wells drilled to the number of active rigs at the same time frame, we see that trend upward very significantly over the last several years. In fact, the number of wells drilled per rig per month was right about 3.5 years ago, and that's moved up to 1.7, 1.8. So that's an 70 or 80% increase in the speed in which these horizontal wells are drilled over the course of about 3 years. So this is a very rapid movement, a very rapid development in terms of how quickly producers can respond to prices, drill new wells, and bring production online. As I mentioned, it's not just an oil story. It's not just a gas story. The shale situation is an overall energy story. So if we look at total cumulative change in production in the U.S. for all these hydrocarbon commodities on a barrel of oil equivalent basis, we see growth in all three commodities. First off, this is natural gas cumulative growth or cumulative change in the total volume of gas being produced in the U.S. versus 2005. Add on top of that are natural gas liquids, ethane, LPGs, natural gasoline, and then crude oil. So we're talking about 10 million barrel of oil equivalent in terms of volume change from 2005 to 2015. And there you can see that slight correction that we are forecasting being the case this year as a whole. So we'll move on into the natural gas market and what these shale dynamics have done to supply and demand in the U.S., what they've done to pricing in the U.S., and then later on we'll get into the impacts on the global market. First off, production, overall production volume. We're talking about a market, the natural gas market in the U.S., of about 70 billion cubic feet per day, or just around 500 metric tons per annum, but 70 BCF in terms of that supply-demand balance. In 2013, just a couple of years ago, we saw production starting that year at about 63 billion cubic feet per day. And that rose pretty significantly up to 67 just in that year time frame. Growth accelerated in 2014 with a huge jump in production coming online as producers began to realize that ability to produce more and more gas and crude per well. But then in 2015, because prices had gotten so low by then, the Henry Hub price falling to around $2, actually created a situation where production of gas moderated and stayed pretty flat over the year last year. And then importantly, we have begun to see a correction in natural gas production over the last several months. So a downward trend of about maybe 2 BCF a day over the spring quarter this year. Now this is important for the balancing of the market. Even though the number of rigs has become less significant, so many rigs have been pulled out of the field that enough supply has been able to come off of the market and give us a bullish signal in terms of Henry Hub pricing. Forecasting the rest of this year, we see a decline in production slowly continuing until the end of this year. And that jump you see there in November, December this year has to do with infrastructure. I'll say more about this in just a moment. The Northeast region, which we see here in the upper right-hand side of, upper left-hand side of the screen, is the new place, the new gas frontier over the last 5 years. So the states of Pennsylvania, West Virginia, and Ohio have really become the growth engine of natural gas production in the U.S. In fact, that Northeast region we saw has accounted for not just the growth in the U.S., but has made up for declines elsewhere. So aside from those 3 states I mentioned, production in the United States has actually declined over the last 3 years. But there's been so much gas that's been profitable at such low prices that producers have been able to bring on more and more and more supply from that region, enough to oversupply the market. Now, honing in on that Northeast region just a bit more, this is our forecast for continued natural gas production growth over the next 5 years. And this black line we have laid over it is takeaway infrastructure. So this is the amount or the volume of gas that is able to be moved to market from this location. And it's changing over time because that Northeast region of the U.S. used to be simply a demand center. So the infrastructure was actually set up to bring gas from other parts of the country into the Northeast. But because of the shale phenomenon, the shale movement that's happened so rapidly, producers have brought on so much supply that midstream companies have been reactionary in catching up. So a lot of these pipelines that did move gas from the Gulf Coast area to the Northeast have been turned around and reversed and expanded to accommodate this gas and move it closer to market. So because this production has been and will for the next year or two still be constrained by the amount of pipeline capacity that exists, this puts downward pressure on prices in that region. So the purple line here we see that corresponds to the right-hand y-axis is the Dominion South Hub basis price. So this is the difference between the local price there and the Henry Hub price, which is in Louisiana. Because there's been so much trapped supply in what has become a supply zone, a lot of downward pressure on these prices has been felt by producers. So this is the price that producers in this region are actually gathering their gas and selling into. Because of the depression of these prices, we have seen producers slow down and stop their drilling activity. In addition to because they don't have anywhere to move the gas due to this pipeline constraint. Now, forecasting this basis price, we do see some recovery because now, when you get up to 2018, 2019, the infrastructure we think will be in place based on future projects. And this will alleviate some of that downward pressure on prices in the area. It'll also incentivize producers to continue production and even increase production as the Henry Hub price gains in elevation over the next 5 years, in addition to that basis price for the Northeast region. I promised a bit about methodology. I'd like to speak about that just for a moment before I get into displaying the Platts Analytics forecast for supply and demand sectors in North America or in the U.S. So in the U.S., all interstate pipelines, that is pipelines which cross state lines, there are about 200 of them. They're all required by the Federal Energy Regulatory Commission. They're all required to post any flows that come onto their pipeline or distributed off of their pipeline. And so they do this electronically on their websites, and they do this collectively for about these 200 pipelines. They're about 30,000 points, and it shows whether the pipeline is delivering gas to a power plant, is receiving it from a production zone, is sending it across the border to Mexico as an export. All of these things. So we actually collect daily flow volumes for these 30,000 points where data is available, and then we model up the rest of the country, or the rest of the continent really, and then forecast based on it. In terms of history, we really see the three main sectors in terms of demand, which we have stacked here. So in the red at the bottom, that's residential and commercial. That's your cooking and your heating use at Rescom facilities. The middle portion there in pink, that's power generation. And the green portion towards the top is industrial use. So these three categories make up the lion's share of natural gas consumption in the U.S. That sliver in orange you see there at the top, that's exports to Mexico, and those have been growing. From the perspective of the U.S. gas market, the exports to Mexico, and later we'll see exports via LNG, are experienced as a demand. So it's creating new demand from the perspective of the gas market, which will place more upward pressure on Henry Hub prices. And then in the black line there, we see the amount of domestic production there in the U.S. That shortfall has historically been made up for primarily by imports from Canada and a few LNG imports as well. So looking at our forecast, you can see that we have reached the point where we're seeing the U.S. gas market actually move on an annualized basis from being a net short gas to being net long gas. So actually producing more gas than it consumes and feeding that demand that's been realized by exports. You can see the orange piece and the maroon piece at the top there, Mexico and LNG exports respectively, are really the huge growth portion of the market. Residential and commercial demand doesn't grow too much. The population growth is not terribly robust, and any population growth and cited gains in demand are usually going to be wiped out by efficiency gains. A bit of an increase in power generation demand. A lot of coal to gas switching has taken place over the last year or two, partially by federal mandate of regulations that make it more difficult to burn coal, but also partly because gas prices have become so nearly competitive with coal that a lot of power generation facilities that have the capacity to switch have switched from using coal to gas. So not a whole lot of natural gas demand coming in the next 5 years, but some. Same story with industrial facilities. But we can see that on a volumetric basis, the big growth engine for demand in the United States are those export pieces. So a bit about Mexico, and then we'll get to the meat of the situation and talk about LNG exports. Mexico, the neighbor to the south, has been seeing declines in its natural gas production. So about a 20% decline over the last 5 years, and a trend that could continue for the next couple of years. They are slightly dependent on LNG imports, but we see those being gradually phased out over the next several years, or at least largely phased out, because it becomes more economical to import via pipeline natural gas from the U.S. And speaking of, those imports from the U.S. have grown by to become about 40% of the total Mexican market. The demand on this, the Mexico demand, is actually a very holistic and robust movement to shift away from using fuel oil as power generation fuel towards natural gas, which is cleaner and more abundant. Because of that, we're seeing a lot of infrastructure being put in place in Mexico. So these green dots you see scattered across the country, those are new build natural gas power generation facilities. And those lines that are weaving their way across are recently built new lines, the solid lines, and the dotted lines are those that are underway in terms of being built out. And this has allowed exports from the U.S. to Mexico to grow quite rapidly over the last several years to become about 5% of the U.S. market. They come through, in terms of these exports moving from U.S. to Canada, come through several different corridors. And then forecasting it, we see that growth continuing to where we have about 5 to 5.5 billion cubic feet a day of Mexican imports from the U.S. But more importantly, in terms of what's going on with the global market, is the build out of LNG export terminals in the U.S. Platts Analytics is forecasting the build out of 5 of these facilities in the immediate future. All 5 of these facilities are underway. There are a host of other facilities that are in various planning and preparation stages, but these are the 5 that we see being built out in the near term. The Cove Point facility on the East Coast, and then the Cameron, Sabine Pass, Freeport, and Corpus Christi facilities in the Gulf Coast. Sabine Pass is already up and running and has sent its first cargoes out into the global market, but it's the only one that is currently active. Looking at this chart, the stack, the colorful stack we see is actually the cumulative and growing train by train forecast of export capacity. So we see Sabine Pass, which has already come online, and it'll be building out multiple more trains over the next couple of years. And then adding to the capacity significantly in 2018 will be Freeport, Cameron, and Cove Point, and then finally Corpus Christi coming online in 2019. Now compare that to the gray line that you see cutting across that stack, that colorful stack. That line is our forecast for actual outflows of gas from the U.S. market. It does include liquefaction demand, but you can see that it's really fairly underwhelming relative to the capacity. And this is really a symptom of, again, that global oversupply situation in the LNG market. So in terms of where the sendout is coming from in these various regions, looking again a little bit closer at the capacity relative to the LNG sendout that we're forecasting, that utilization rate is really pretty underwhelming. So these capacities look like they'll be utilized at about a 30 or 40% rate over much of the next 3 years before really coming out to a more robust point there in 2020. So we'll say a little bit more about this in a moment, but I want to cut to the chase in terms of the U.S. gas market and its imports to prices, and then we'll come back to another look at the LNG market globally. Back up a moment. So this is our price forecast for Henry Hub. Henry Hub being the primary gas hub, natural gas hub in the U.S. The dotted line, which is higher, is our forecast, and we wanted to put it just relative to the NYMEX forward curve for comparative sake. But assuming normal weather, assuming a typical winter weather situation this year and next, and continued declines in production that we saw earlier a few slides back, we see a tightening of the market, and we're forecasting for gas prices to improve to $3 and a little bit above by this winter. This is also, again, partly because of increased LNG cargo exports, which, despite being underwhelming in the foreseeable future in terms of capacity, it's actually a significant portion of the U.S. market in terms of its excess supply finding a home somewhere else on the globe. Longer term, we are a bit more bullish than the forward strip, or than the market would be in terms of its anticipation. But it's going to depend on how fast producers really do ramp up production in response to these price increases. We do see a price ceiling of about $4.50, somewhere in there, where our prices max out in 2020, 2021. And it's because, as I mentioned earlier, so much production, so much reserve left in these shale plays is so economical at that price that producers have the ability to quickly turn on supply and flood the market once again. And putting a bit of numbers to this, Joel showed us this on the oil side, but we have a model that actually estimates the return a producer can hope or expect to achieve given a typical well, a single typical well drilled in every major player basin across the country. And so if we look at that, that's what we're seeing here on the bottom of our screen here, is a list of several gas-oriented, wet or dry gas-oriented plays. And the return that producers expect to get at current prices of about $2 is not profitable. So that's why we've seen production drawback. However, moving that price up to $3, some of those key plays, the Marcellus and Utica, those are the basins there in the Northeast region that we spoke about, in West Virginia, Ohio, and Pennsylvania. Those move back up to the 10% region with a Henry Hub price of $3. But as that price moves to $4, those plays become very economical, and we'd expect producers to get very active once again in that region. And then other supply centers become in the money and profitable once again at that point. So this is relating back to that price ceiling that I described, considering the last slide. I mentioned infrastructure. If we're talking about a price increase, really assisting and helping out that return that a producer can expect to get 2-3 years down the road in the Marcellus area. But if that infrastructure is not yet available to move excess gas to market, geographically speaking, there's several other plays that do have connectivity to market that will be profitable, that will be in the money at a $3.50, $4 Henry Hub price. So despite that infrastructure constraint, a good enough price signal, a high enough price signal, will actually increase production in the U.S. regardless. So moving to liquefied natural gas and the global market and what the U.S. natural gas story and shale production have had in terms of prices first. So we're looking at three major global gas prices. At the bottom there, that's the Henry Hub that we forecasted just a moment ago. Second one up is the national balancing point in the UK, and the green line there. In the purple line towards the top, for most of the time, that's the Japan career marker. That's Platts gas price assessment for Northeast Asia. And then finally, the oil index price based on the Brent price that many contracts globally are traded upon. Now, if we look at this graph, over the last 5-6 years, we see three pretty distinct segments in terms of what these markets have been doing. In 2010, we saw a global LNG oversupply situation, which was rapidly and immediately and significantly adjusted by the Fukushima disaster in Japan, which created and stimulated a lot more natural gas demand, bringing us into that new time frame of 2011 to 2014, even early 2015, in terms of high spreads, incentivizing a lot of production, or a lot of investment, rather, in LNG export terminals in the U.S., and Australia, and other places as well. And then finally, we're looking at the story we know all too well in terms of the global hydrocarbon oversupply situation, where the markets have been saturated and flooded, and prices have collapsed across the board. And so that's actually brought in the spreads between these natural gas hubs across the world, and shrinking, or if not eliminating at times, the arbitrage opportunity that would make it profitable for LNG to flow from U.S. shores. In terms of the global capacity build-out, we can get a visual for just how rapid we've seen these terminals go up. So looking historically over the last few decades, you can see we've reached a point and are currently building up to a point of an enormous amount of LNG export capacity. You see there the larger chart. If you look towards the outer year, the green portion there towards the bottom is that U.S. export terminal capacity. And that's really adding to the oversupply of this terminal capacity. Meanwhile, demand is shifting. So looking at global LNG demand and which regions are the growth portions of it. Asia Pacific, of course, the big driver, the big piece of the market. But we saw demand in that region decline slightly last year. This is important, of course, as supply is coming online at a rapid pace, that the biggest demand zone has actually seen a drop-off in its demand. It's been partly, if not largely, recovered, though, by additional shipments into Europe, South America, and even a few into other parts of Latin America and Africa. So it's being partly offset, but where these demand zones actually go next is going to be a significant and important piece to watch going forward. Now think back to this in terms of what's actually gone on here at the U.S. level. We mentioned that Sabine Pass has already come online, and I want to focus in on a little bit that those shipments are actually taking place. So here's a list of, I believe it's 13 cargoes that have departed the Louisiana shore from Sabine Pass since it got up and running in February. So these cargoes have gone to various points throughout the globe, and it's important to see, we see a few shipments actually staying in not just the Atlantic Basin, but in the Americas. And this is something we may see going forward. If you recall the gap closing between European prices and Henry Hub, that arbitrage window may be small enough or may actually be eliminated entirely for a long enough time to keep those LNG cargoes in the Americas. However, those shipments to the Americas could be, the U.S. could have a very, very significant hold on that market going forward. So in terms of netbacks, and this is important to really get a feel for, U.S. Gulf Coast LNG netbacks. You see them in terms of what's gone to Europe, what's gone to Asia via the Panama Canal, or going around South America. Any way you slice it, these netbacks have gone south. They have turned significantly down because those spreads from various locations, say Henry Hub to the national balance point in Britain, has come down quite a bit. A bit about these contracts, what we call the Sabine Pass model, the way these contracts are actually designed are, there's the capacity reservation, which in terms of shipment really is a sunk cost. And instead you're looking at, in terms of making a decision to flow gas one way or another, you're looking at how much does the gas cost at Henry Hub, and then adding 15% for a liquefaction fee, and then adding transportation, which gets us to requiring a spread of probably less than $1, but somewhere in the 75 cents range in terms of what's necessary for LNG shipments to make it to Europe.